Welcome back to If the Public Only Knew. I'm Gary Sinderbrand. Today we're going to go into a topic that often stays in the shadows. Frankly, I'm surprised more clients don't bring it up right at the front end of a relationship or even before signing on. And it's going to really be a discussion around conflicts of interest as it relates to commissions, fees, hidden costs, and all sorts of things that the general public doesn't really know what to look for. Now, you've been with your advisor for a long time and you've done well, probably not all that concerned about it. But as many of you already know, 37% of financial advisors are going to be retiring over the next 5 to 10 years. That's about $3 trillion in assets. So what it means is the industry is going to lose a significant portion of its more experienced and wiser advisors. As this passes on to the next generation, we can't assume they're going to approach things the same way that your advisor of 20 or 30 years did, maybe even longer. So let's keep that in mind as we think about it. That's not necessarily a good thing or a bad thing, but it is something that we need to keep track of. Now, most people, or I should say, most advisors I talk to have been successful in converting their practices from commission-based or brokerage fees to a wrap account or a fee-based only account. Now, there are some clients out there who just refuse to pay fees. There are some out there that understand that that's probably a more optimal way to go. In my own practice, I switched to a fee-only arrangement with very few exceptions sometime in the early 80s. I think I was ahead of most of the curve. I didn't have a lot of choices as to what I could do, but I utilized wrap accounts or fee-based accounts that would allow me to tell the client a couple of different things. If you sign on with me as your advisor, you will know exactly what you're going to pay. You're never going to be surprised. My goal going forward is to charge you as much as I possibly can. Now think about that statement for a minute. Sounds a little nutty, but if I was being paid a fixed percentage of that client's assets, the only way I could get more assets or more compensation was either to grow those assets in line with the plan I had laid out and the client signed off on, or the client would bring in supplemental assets. So it put us on the same side of the table, even though clients may have been resistant sometime to pay a fee. The alternative to that would be every time I would call the client up with a suggestion as to some transaction they should do in their account, that client should or could automatically be on guard. Is this suitable for me? Is this the best thing for me to do right now? I've got to pay a commission. So not only do I have to figure out whether or not this is the best transaction to me, but by the same token, I've got to figure out whether or not this is a transaction being generated because my advisor needs some additional commissions, or this is truly what I need to do. And that's just the beginning of the whole thing. Clients that are in commissionable or brokerage type accounts that may add supplemental products to their account, even if they're in a wrap fee, have to inquire as to what the compensation is going to be for the financial advisor, even if the commission is buried inside the product. Let me explain what I mean. If you buy something like an alternative investment or any type of partnership, you're going to pay a supplemental fee. Now, you won't see it right away, but if you read the prospectus, you've got to pay basically the brokerage house. They've got to pay the advisor. They've got to pay management fees. They've got to pay accounting fees and all the other things that are there. So you may put $100,000 away and only about $92,000 of your money goes to work. Is that a good thing or a bad thing? Well, that brings us back to the same discussion. Are we paying cost or are we gaining value? Value is something we only perceive in a rear view mirror. Somebody tells you it's great value for the fee. You have zero experience with it. It's not like you're buying an iPhone and it's an identical model at half price. There you can determine value. Here you can't. So what do? A couple of things. First of all, I would absolutely recommend that if you cannot find an advisor that you have faith in that will charge you a fixed fee, you don't have the right advisor or you're not looking hard enough. You have to find someone that you get along with, understands what your goals are, and be very clear about why you're hiring them. You're hiring them to get you from where you are, which we call point A, to somewhere down the line, which we'll call point B. All sorts of things happen in the meantime. Things occur that you thought would happen. Things don't occur that you didn't expect. All sorts of things can change. You would need an advisor that's going to be able to react to those changes in your personal situation, as well as what the market might be doing, and be able to guide you without you thinking for a minute that every time you see that name come up on your call ID on your cell phone, you've got to gird yourself and figure out whether or not that call is to generate a trade for the advisor or it's in your best interest. That takes us into another direction. The individual buy and sell decisions should never be made by clients, except in very, very particular circumstances where the clients are actually qualified not to destroy themselves by an emotional response to some external event or a recency bias, which we'll get into later, or some form of confirmation bias. If you look at studies done by a company called Dalbar, they will basically explain that year after year after year, individual investors left to their own devices will consistently underperform the averages. Why? Because it's your money. You get emotional with it. You just can't help it. As an FA, I was completely passionate about the outcome I wanted to see from my clients and totally dispassionate about how I got there. My clients didn't hire me to be emotional. They hired me to get them to a goal. I cheered them when they won. I was happy for them. And I was sanguine when it didn't quite work out more often than not because the client changed goals. This approach, if you're clear in your goals and you don't change them up, down, and sideways every other day, don't try and help your advisor get you where you need to go, pay a fee for that because that's true value. Your advisor looks at it this way. This client is someone that I really enjoy working with. We've developed a great working relationship, almost a friendship. At the same time, they follow my guidance, but they ask good questions as we go down the line, because one of the responsibilities of any advisor is to educate their clients as things occur. If you are paying commissions, you need to understand that your performance, again, except in very rare circumstances, is going to be a fraction of what your advisors are getting in their wrap accounts, which primarily are their fee-based accounts, which primarily the buy and sell decisions are made, not by your advisor usually, but by outside managers of equity and debt. Now, one more thing, just to make it a little bit more complicated. It's entirely possible that you do have an advisor that's pretty good at picking stocks. In fact, you may have been with them for a long time, and they may have substantial capital gains built in to picks that they made years ago. I have a lot of senior advisors that I coach and consult with. Several of them have Apple at $21, and they have NVIDIA at $5 or less than what the dividend on NVIDIA is now. Now, they never charged a fee back then because fee-based accounts just weren't worth it. So what do we do there? Well, the answer is you don't just take that and put it into a fee-based account. And I'll get into low-cost basis stocks for people, let's say, over the age of 60 or 65, where the gains are pretty high. You don't want to absorb them. I'll get into some thoughts as to how we can handle that in a later podcast. But that is not money that should go in to any type of managed account. If that money, however, is invested in a qualified account where those gains can be taken, you have to ask yourself a very simple question. If you had nothing but cash, which was the equivalent amount, what those highly appreciated equity positions were, would you rebuy them today? And if the answer is, oh no, I would never have that much concentration in one stock, then the question becomes, why do you own it? And your advisor should ask those types of questions because you're not going to hit every time you go out there. Last thing, and then we'll move on. I always tried to approach my business after I figured out what was going on with the same earnestness and determination to put my clients first that a fiduciary would have. This was long before the regulation BI or Reg Best Interest came out, where all you had to do was have something called suitability. Suitability's got a lower standard of care. It also would allow your broker or advisor to put their interest ahead of yours. assuming the recommendations were still good for you. I don't know that I would call that necessarily a conflict of interest, but you want to have a financial advisor that acts in the capacity of a fiduciary, which is always putting your interest first, beyond suitability. It's pretty important to recognize that. If, however, you ask your advisor, can you quote me all the fees I'm being charged? And that advisor comes back and just shows you what the management fee happens to be on the account overall, and doesn't dig into the inside investments, the mutual funds, partnerships, anything else that might have a cost associated with it that maybe even the advisor doesn't get and you don't see, my recommendation is have him go back and sharpen his pencil. And if they can't figure that out, probably need to be with another advisor because there's things happening you're not aware of. This is your money. You have every right to know exactly where every dollar in expenses is going. Whether or not that ends up being cost or value, an individual assessment. You're going to have to figure that out with your advisor. But if there's any question at all and your advisor can't identify what they do to add value, you probably want to move on. Thanks for listening. If you like what you're hearing, spread the word. Send the link to a friend. Hell, send it to your advisor. Have them listen to it. Thanks for your time. Talk to you again soon.